Fixed rate versus variable rate. With a fixed rate mortgage, the interest rate is determined when you apply for the mortgage. This interest rate is set for the entire term. The amount of your regular payment is also fixed. Fixed rate mortgages give you protection against potential rate increases during the term. Once the term is up, you'll have to renegotiate at market rates. Variable interest rate mortgages, also known as adjustable rate mortgages, because the rate will vary or adjust during the term. The interest rate is tied to the prime lending rate, which changes based on the rate the Bank of Canada charges the lenders. While variable rates start off lower than fixed rates, you have no rate guarantee, so if rates go up, you could end up paying more than you would have with a fixed rate. There is a risk factor built into the variable rate mortgages. You can also lock in a variable rate mortgage to a fixed rate at any time, but only at the fixed rates available at the time you lock in. So again, you are at some risk if rates go up. To guess whether fixed rates or variable rates will go up or down, you first have to understand that they are impacted by different criteria. Fixed rates are affected by the bond markets, and variable rates are tied to the prime rate, which is affected by the Bank of Canada. Notice how the fixed and variable rates at times are close together then far apart, then close together then far apart. You can see from this chart that while over the long term they move in the same direction, but on short-term cycles they can move independently from each other. So how do you choose which is better for you? There are two strategies to use. Number one, you can take an educated guess as to whether fixed or variable rates are going to go up or down. You can improve your odds a little bit by understanding how rates are affected and reading interest rate forecasts by industry experts. Keep in mind that the experts are not always right. There are just too many factors that affect rates to make forecasting accurate. Number two, you could base your decision on your tolerance to risk. This is a safer method because you're not guessing what might happen to rates. You do know what your tolerance to risk is. Fixed rates are safer because you have a rate guarantee for the term of the mortgage. So if you don't like risk and you sleep better knowing what your rate and payments are, then choose a fixed rate mortgage. If on the other hand you like risk and you can afford an increase in rates, then take a variable rate mortgage. And if they do not go up, you'll save money. I recommend that you base your decision on your tolerance to risk and your financial tolerance to interest rate increases.